Hey everyone, welcome back to Finance Kita, your go-to place for all things finance knowledge. Today we're diving into a topic that's super relevant for those of you looking to ace your interviews in the finance world, specifically for chartered accountants. We'll be focusing on some key interview questions related to super important topic MIS, Management Information System Statement, or monthly income statement for an interview. Grab a cup of coffee, settle in, and let's get started. Now, let's explore what an MIS statement is and why it holds such significance in financial management. An MIS statement or Management Information System statement serves as a structured report that distills complex financial data into digestible insights for decision makers. It encompasses key elements like revenues, expenses, cash flows, and performance metrics, all aimed at providing a comprehensive overview of the organization's financial health. The importance of these statements cannot be overstated. They empower management to make informed decisions, guiding strategic planning and operational efficiency. By analyzing trends and identifying anomalies, an MIS statement acts as a vital tool for forecasting and resource allocation. It transforms raw data into actionable intelligence, ensuring that the leadership team is equipped with the insights necessary to navigate challenges and seize opportunities. In essence, an MIS statement is not just a report, it's a cornerstone of effective financial management. Now, what are the key components of an MIS statement? Typically, it includes financial performance metrics like revenue and expenses, along with operational data that highlights efficiency and productivity. It also often contains forecasts, variance analyses, and key performance indicators or KPIs that align with the organization's strategic goals. So when discussing MIS, emphasize its role in transforming raw data into meaningful information and highlight how its components work together to support effective financial management and strategic planning. Let's dive into how MIS reports support strategic decision-making in finance. These reports provide critical insights into financial performance, enabling leaders to identify trends, assess risks, and allocate resources effectively. By analyzing data from various sources, MIS reports help in forecasting and budgeting, ensuring that financial strategies align with the organization's goals. They serve as a decision-making tool, allowing finance teams to present actionable recommendations based on real-time data. Now, how do you prepare an MIS report? Start by gathering relevant data from various departments, ensuring accuracy and consistency. Next, organize this information into a clear structure, focusing on key performance indicators that matter most to your stakeholders. Use visual tools like graphs and charts to make the data easily digestible. Finally, review the report for insights and clarity before distributing it to decision makers. Remember, the goal is to provide a comprehensive overview that aids in informed decision making. What are the key financial ratios included in MIS reports and why are they important? Financial ratios like the current ratio, quick ratio, return on equity, and debt to equity ratio are essential. They provide a snapshot of a company's financial health, helping stakeholders assess liquidity, profitability, and leverage. For instance, the current ratio indicates whether a company can meet its short-term obligations, while return on equity reveals how effectively management is using equity to generate profits. These ratios guide decision-making, investments, and strategic planning. Now, how do you handle data discrepancies while preparing MIS reports? It's crucial to have a systematic approach. Begin by identifying the source of discrepancies, whether it's data entry errors, outdated information, or system integration issues. Implementing robust data validation checks and regular audits can preemptively catch errors. Communication with relevant departments is key to resolving discrepancies swiftly. Always document the resolution process to maintain transparency and improve future reporting accuracy. Next, how does variance analysis play a role in management information systems, or MIS? Variance analysis is essential because it helps organizations understand the differences between planned financial outcomes and actual results. By analyzing these variances, businesses can identify areas where performance is lacking or exceeding expectations. This insight is crucial for informed decision-making, allowing management to adjust strategies and allocate resources effectively. Now, can you explain the concept of dashboards in MIS reporting? Dashboards serve as visual displays of key performance indicators, metrics, and data points, providing a snapshot of organizational performance at a glance. They facilitate quick assessments and enable managers to monitor trends over time. A well-designed dashboard can enhance data comprehension, making it easier to spot anomalies and opportunities. So remember, variance analysis and dashboards are pivotal in transforming raw data into actionable insights for effective management. When it comes to preparing Management Information System reports or MIS reports, the tools and software you choose can significantly impact your efficiency and accuracy. Commonly used tools include Microsoft Excel for data manipulation and analysis, Tableau for data visualization, and ERP systems like SAP or Oracle for integrated reporting. Each of these tools offers unique features that can streamline the reporting process. Now, let's discuss how to design an MIS report specifically for monitoring receivables. Start by identifying key metrics such as aging of receivables, collection rates, and outstanding balances. Structure your report to include clear visualizations like charts and graphs to provide a quick overview of the data. Incorporate filters to allow users to drill down into specific time periods or customer segments. Finally, ensure that your report is not just a data dump, but tells a story about your receivables, highlighting trends and actionable insights for decision makers. Now let's discuss how to ensure the accuracy of MIS data. It's essential to recognize that accuracy begins with data collection. Make sure you're using reliable sources and standardized methods for gathering information. This means implementing rigorous data entry protocols and utilizing automated systems where possible to minimize human error. Next, regular audits are crucial. Schedule consistent checks to verify that the data aligns with original documents and reports. Employ data validation techniques, such as cross-referencing with other datasets, to catch discrepancies early. Training staff on the importance of data integrity can't be overlooked either. Everyone involved should understand the impact of their work on overall accuracy. Finally, consider using advanced analytics tools that can flag anomalies or trends that seem off. By emphasizing these practices, you'll not only enhance the reliability of your MIS data, but also build trust with stakeholders relying on that information. Now let's discuss the role of MIS in forecasting and budgeting. The first step is to understand that MIS provides a structured framework for analyzing historical data, which is vital for creating accurate forecasts. By integrating data from various departments, MIS allows organizations to identify trends and patterns that inform budgetary decisions. It's not just about numbers, it's about understanding the story behind those numbers. This holistic view facilitates more informed predictions about future financial performance, enabling businesses to allocate resources effectively. Next, let's explore how MIS reports can help identify cost-saving opportunities. By analyzing detailed reports, organizations can pinpoint inefficiencies in areas where expenses can be trimmed. Look for metrics related to operational costs, supplier performance, and resource utilization. The key is to present this data in a way that highlights actionable insights, guiding decision makers towards strategic initiatives that can lead to significant savings without compromising quality or service. Now, let's discuss what are the challenges faced in preparing MIS reports. One significant hurdle is the inconsistency of data sources. When information comes from various departments, each with its own systems and formats, it becomes a daunting task to consolidate and ensure uniformity. Additionally, the time constraints often lead to rushed reports, compromising quality and accuracy. Another challenge is the lack of skilled personnel who understand both the technical aspects of data analysis and the business context, which can result in misinterpretation of data. Now, let's consider an example where an MIS report significantly improved financial performance. A company struggling with high operational costs implemented a detailed MIS report that analyzed expenses across departments. By identifying inefficiencies and areas of overspending, management was able to make informed decisions, streamline processes, and ultimately reduce costs by 15%. This not only boosted profitability but also fostered a culture of data-driven decision-making within the organization. Next question, how MIS reports contribute to compliance and regulatory reporting. These reports play a vital role in ensuring that organizations adhere to legal standards and industry regulations. By providing a structured format for data presentation, MIS reports help in tracking compliance metrics and identifying areas of risk. They allow businesses to generate timely reports that meet regulatory requirements, thus avoiding penalties and enhancing transparency. Moreover, the ability to analyze trends over time aids in proactive compliance management, ensuring that organizations stay ahead of potential issues. Now, let's explore the difference between MIS reporting and financial reporting. While both serve to inform decision making, MIS reporting is broader in scope, encompassing a variety of operational metrics beyond just financial data. It focuses on performance indicators that drive business strategy, whereas financial reporting is primarily concerned with the financial health of an organization. Understanding this distinction is crucial for leveraging both types of reports effectively in strategic planning. Now, let's discuss how to prioritize KPIs for an MIS report in a fast growing company. Start by aligning KPIs with strategic objectives. Identify which metrics drive performance, such as revenue growth, customer acquisition costs, and operational efficiency. Focus on a balanced mix of leading and lagging indicators to provide a holistic view of the business. It's crucial to engage stakeholders from various departments to ensure that the selected KPIs reflect the company's goals and challenges. Regularly review and adjust these priorities as the business evolves to stay relevant in a dynamic environment. Now let's tackle how to deal with incomplete data while preparing an MIS report. First, assess the impact of the missing data on your analysis. Use statistical methods to estimate gaps, but be transparent about limitations. Prioritize gathering supplementary information through surveys or interviews where possible. Document assumptions clearly and provide context in your report to guide decision makers, ensuring they understand the potential implications of the incomplete data. Next up, let's explore the insights derived from a cash flow MIS report. A well-structured cash flow report reveals more than just inflows and outflows. It highlights liquidity trends, operational efficiency, and potential investment opportunities. By analyzing patterns in cash movements, you can identify seasonal fluctuations, pinpoint areas of overspending, and forecast future cash needs. It's essential to segment the cash flow into operational, investing, and financing activities to understand where your money is coming from and where it's going. Next, if the MIS indicates a decline in profitability despite increased sales, here the investigation must be thorough. Start by examining the cost structure. Are production costs rising? Next, analyze the sales data. Are discounts or returns impacting the bottom line? Look into overheads and fixed costs as well. Finally, consider external factors like market trends or competition that could be squeezing margins, ensuring you have a holistic view of the financial landscape. Finally, let's explore how to explain an MIS report to a non-financial stakeholder. It's vital to start with the basics. Define what an MIS report is and why it matters. Emphasize that it's a tool for informed decision making, not just a collection of numbers. Use simple language to break down key components, such as metrics and KPIs, focusing on their relevance to the stakeholder's role. Illustrate with relatable examples. For instance, if discussing sales data, connect it to how it impacts their department. Visual aids like graphs or infographics can be incredibly helpful as they transform complex data into understandable visuals. Encourage questions and be prepared to clarify any jargon. Ultimately, the goal is to convey that this report is a valuable resource for strategic insights, empowering them to make informed decisions that align with the organization's objectives. This approach fosters collaboration and enhances overall understanding,